Over 2 million homeowners are behind on their mortgage or facing foreclosure right now in the United States. And that's up 91,000 from last month. Mainstream media would have you believe that everything's A-okay with the housing market. But I'm seeing cracks under the surface. And these are warning signs most people aren't talking about. Today on The Housing Nerd, we're digging into the future of the mortgage market, why these problems are growing, and whether or not we're headed for another 2008 style meltdown. If you want to really understand what could go wrong in the housing market over the next 12 to 24 months and what to watch for, stay tuned. And one of the signs you have to pay attention to is the seriously delinquent loans. Because right now, mortgages that are 90 days or more past due are up 8% year over year, or 35,000 seriously delinquent loans more than we had last year. And what's worse is that FHA loans, in other words, borrowers that are at the biggest risk of default and oftentimes the lowest income borrowers, those loans account for 51% of all serious delinquent loans. Not only that, but foreclosures are rising, up 10% year over year. And that's the fourth month in a row that we've seen a year over year increase in foreclosure starts. So let me know in the comments below, are you surprised that mortgage delinquencies are rising like this? Are you seeing more foreclosures in your neighborhood? So one has to wonder what's causing all these mortgage delinquencies and foreclosures. Well, we're going to break that down right now. One of the biggest things is property taxes, because in some areas, property taxes have increased 10, 15, 20, 30, 50, 70% or more in the last 5 years. And so while a lot of homeowners have fixed rate mortgages, insurance and particularly taxes have exploded. And that's put extra burden on some of these homeowners and caused them to default. When we take a look at this article from Realtor.com, they say the warning signs are getting harder to ignore. In Mahoning County, Ohio, which is near where I live, the tax delinquency rate has hit 18% with more than $70 million in unpaid property taxes in this one Ohio county. And in some neighborhoods, like in Youngstown, Ohio, they're seeing even higher default rates. It's as high as 33%. 1 in 3 homeowners are defaulting on their property taxes. And they go on, in Cuyahoga County, values jumped 32% on average after reassessments, fueling a $60 million increase in past due property tax balances. And this problem, folks, could get much worse because, again, according to Realtor.com, homeowners in Ohio face an additional 25% increase in property taxes in the coming years unless lawmakers step in. Now, paradoxically, there is an effort right now to completely abolish property taxes in Ohio. But make no mistake, that money for schools and city services has to come from somewhere. So one way or another, the officials are going to get our tax money. And so this burden that homeowners are facing, and one of the reasons they can't make their mortgage payments, that burden's not really going away. Now, I've done a couple videos about property taxes in Ohio, and you can check that out right here. But something that's a big concern of mine as well is total debt of households, because that's exploded to over $18 trillion total in the U.S. Now, a little over $13 trillion of that is mortgage debt, but the other $5 trillion are made up by other forms of debt, oftentimes not good debt. The New York Fed points out that credit card balances rose by $27 billion in the second quarter of 2025 alone, and now total $1.21 trillion. What's worse is that auto loans increased by $13 billion in the second quarter, and now stand at $1.66 trillion. But maybe the biggest red flag of all the debt problems in households right now would have to be student loans, because those balances increased by $7 billion in the second quarter of 2025 and now stand at $1.64 trillion. But it's not just the balance of these loans. It's the fact that a good portion of them are now in default. And many times you can't absolve the student loan debt through a bankruptcy. You can't just wipe it away like you can a credit card. So borrowers are forced with either having to pay their mortgage payment in some cases or their student loan. But it's a tough choice, because if they default on their mortgage, they may be foreclosed on and not have a place to live. If they default on their student loans, though, they can have their wages garnished. So I think a lot of people will choose to miss their mortgage payment versus their student loan payment. But let me know what you think. So all this increased debt and increased debt payments and tighter budgets, that's all leading to more defaults and more foreclosures. But that can actually be an opportunity for you if you've been waiting for lower home prices or buying a discounted property. More on that in a minute. So we've talked about how foreclosures are up 10% year over year, but you may have noticed that there aren't a lot of foreclosures out there on the market. And one has to wonder, why is that? Why aren't we seeing more foreclosures? Well, one reason, and a big reason, is because the government has artificially suppressed the foreclosures through COVID-era loss mitigation programs. So this article I'm looking at now is from the Wall Street Journal. And it says, under the guise of COVID relief, the Biden administration masked growing troubles in the housing market by paying off borrowers and mortgage servicers to prevent foreclosures. Of the 52,000 FHA loans last year, and this would have been in 2024, that went seriously delinquent within their first year, only 9 resulted in foreclosures. So this is crazy. In 2024, you had 52,000 FHA borrowers, house buyers that couldn't make a payment in the first year they owned the home, and the government stepped in and actually made these payments for them. Comment below, did you know this was going on? They go on to say, the FHA instituted a program that pays mortgage servicers to make borrowers miss payments for them. Missed payments are added to the loan's principal, but without interest. The FHA also pays servicers, or the actual originator of the loan, like a bank, to cut monthly payments for delinquent borrowers by 25% for 3 years, with the payment reductions also added to the principal without interest. In other words, there are thousands, tens of thousands, over 100,000 homeowners right now who haven't had to make a mortgage payment, sometimes in the last 1, 2, or 3 years. They're effectively gaming the system, not having to make payments. The government's doing it for them, and the bank that actually originated the loan is profiting off of it. And they explain how this works. Consider a borrower who missed 5 $4,000 monthly mortgage payments. The mortgage servicer will add the $20,000 in missed payments to the mortgage and reduce monthly payments by $1,000 for 3 years, adding another $36,000 to their mortgage. So the borrower is $56,000 deeper in debt, though with no additional interest. If he misses payments again, the servicer rinses and repeats, getting paid $1,750 every time it lathers up. The FHA also lets servicers charge borrowers legal fees, typically several thousands of dollars, that are added to the mortgage principal. And I've seen this firsthand. As a realtor and investor, I've looked at folks' mortgage statements when they're in trouble on their mortgage, and I've seen these insane fees and legal bills that are added into their mortgage loan balance. And so not only do we have borrowers gaming the system, we have the officials gaming borrowers. Now, this next part, you got to be sitting down for, because this is going to make your blood boil. The FHA made 556,000 incentive payments to servicers over the past year to prevent foreclosures. Nearly as many as mortgages it insured. Government-backed mortgage relief has become a cash cow for servicers, some of which originated the risky loans they are paid not to foreclose on. Moral hazard, anyone? Absolutely. Tell me what you think. Now, what this loss mitigation and these forbearance programs really mean is that homeowners who have taken advantage of this program, and don't get me wrong, many times they need the program, they need the relief, and that's fine with me. But a lot of people have gamed the system. One result of this FHA monkey business is that borrowers could owe more on their home than it's actually worth, especially given the fact that in a third of the country right now, home prices are going down. So values aren't increasing. They're actually decreasing in many areas of the U.S. They're essentially trapped in their homes with no ability to refinance and no ability to sell. And that equals, in many times, a short sale or even a foreclosure. And kind of a side effect to all this, folks, and I'm sure you can see this, is that home prices could have been artificially propped up over the last few years because the distressed properties that typically hit the market are not hitting the market now and haven't for the past few years. So values remain higher because values are determined by many times comparable sales in the area. So if there are no foreclosures in an area that are sold at a discounted price, that can artificially keep values high and make home prices more unaffordable. And tell me what you think. Have values artificially been propped up because of this loss mitigation? Now, obviously, if all this blows up, taxpayers, you and I, are going to be responsible to plug the gap. But it actually gets much worse because according to John Comiskey, who's a Substack writer and mortgage expert, 70% of all those mortgage modification borrowers are actually delinquent now. And of the 70% that are delinquent, 55% are seriously delinquent, meaning they haven't made a payment in 90 days. So these borrowers called the servicer and said, hey, I can't make my payment. Can you lower it? The servicer modified the mortgage, and now the borrower can't even make the new lower payment. So you may be wondering, are they going to end this free money program, this grift? Yes and no. Later this year in October, the Trump administration has decided that they are going to end the program the way it looks now. In October of this year, they're going to make a change, and you're going to have to make some trial payments in order to actually enter the modification program. So there's some guardrails around it. They're also only going to allow one of these mortgage modifications or extend and pretend every 12 to 18 months. So you can't do it all the time, continually. You're going to have to face the music at some point. So while the program is ending, the grift will continue. And I honestly don't think it will end completely. I think whatever administration's in the White House, they're going to kick the can down the road. They're going to keep allowing people to play these charades because they don't want a foreclosure and housing meltdown on their watch. But comment below and tell me what you think. I'd love to know. So are we headed for another 2008 style crash and meltdown? One of the major differences is the subprime mortgage market. Back before the GFC, and one of the major causes of the great financial crisis was the fact that borrowers were able to take out loans on homes with really no income verification, and there were really exotic loans that they could use. For instance, they could have an interest-only loan on a primary home, or they could have an adjustable rate loan and even a negative AM loan or negative amortization. And that means that your balance goes up over time, not down. And so human nature is they'll pay the lowest payment possible. So a lot of homeowners leading up to the GFC were like, you know what? I can make a payment that is the real payment, a full principal and interest, or I could make my minimum payment, which is like a credit card minimum payment, basically interest only. And so that debt never goes down. And not only that, many of these borrowers were not qualified at all to actually get the homes. But because lenders had such loose lending standards, many of the borrowers who were not supposed to be qualified anyway, purchased homes they couldn't afford, and then defaulted. And all those defaults piled up on top of each other, and inventory of homes for sale in the US skyrocketed. But now things are much different in the lending process. Now, a lot of people say, and they want to believe, that we are in another 2008 right now, but lending standards in the mortgage market are much different. Just try to go get a mortgage and see if you can get one with a stated income and ask for an interest-only loan on your primary house. You're not going to get it because lenders are much more strict on who they loan to and the loan structure. And so that's kind of put guardrails around how bad it could actually get. But if you don't make a mortgage payment, then it could get bad, obviously. And delinquency rates are nowhere near now where they were during the GFC. Overall, the delinquency of mortgages was around 11 to 12% leading up to the worst years of the GFC. Now, like we said earlier, it's about 3.35. So we've got a long way to go before we get to that type of delinquency. The other thing is adjustable rate mortgages and subprime loans, those delinquency rates were running 28% plus. So nearly a third of all those borrowers were actually seriously delinquent on their mortgages. And that caused a massive foreclosure wave. Another factor to consider is that 40% of all homeowners now own their home outright, with no mortgage at all. So they really don't have an adjustable rate mortgage or interest-only loan to even worry about. Now, they still have to worry about taxes and insurance, so those can continue to eat into people's budgets and cause distress and defaults. But overall, fewer people have mortgages on their homes, and that's fewer people that could probably enter distress. Because even if taxes and insurance go up, it's still probably less than what they were paying on their mortgage with property taxes and insurance, principal and interest, if they were to buy a house now. So during the GFC, about 30% of homeowners own their homes outright. So the difference is quite a bit when you consider the number of the homes in the US. Now, many of the people that do have mortgages now have low interest rates. And that's another factor, another difference between now and 2008. People who have ultra low interest rates oftentimes have ultra low payments. And so a lot of these folks, even if they are struggling financially, they will do everything they can to stay in their homes and not put them on the market because they have a payment, a total payment that's lower than what they could get if they had to go out and buy a home, certainly, or even rent a place. And so those locked-in homeowners, again, will do everything they can to stay in that home. And I think that's going to dial down a lot of the distress. The last big difference, and many people are not going to like this, is the investor. After the GFC, there was an explosion in the number of investors that came in and bought properties for pennies on the dollar. And since then, Wall Street and even small investors like me have realized, hey, housing is a great investment. Properties can appreciate. It's a great way to build wealth. And whether you like that or not, doesn't really matter. That's the truth. So you have to ask yourself, what's going to happen with the housing market if property prices get low? Will investors just walk away from them or walk past them? No, they're going to swoop them up. I think what we're going to probably see as more distress builds and properties hit the market at lower prices, you're going to see investors and even homeowners swoop them up. And make no mistake, I don't think investors will save the housing market necessarily, but it's a factor to consider. And it's a factor we really weren't facing in 2008 as inventory built. I mean, you can see inventory for homes for sale hit nearly 4 million units back during 2008, 2009. Now we only have 1.24 million homes for sale. And heck, before the GFC, we had 2 million homes for sale. So we're way undersupplied when it comes to distress levels, in my opinion. And if we see that spike in distress properties on the market, I think investors, the smart investors, will step in and buy them. I also think many of you on the sidelines, as you've told me, have cash ready and are waiting for the crash. And so you are going to be competing with everybody else, unlike, I think, leading up to the GFC. But tell me what you think. Am I way off? I'd like to know your opinion. Don't get it twisted. 2008 was wrecked by subprime mortgages, risky lending, and a flood of inventory. Today's market definitely has its red flags, but it's not the same market we had in 2008. And that definitely matters. But how can you take advantage of this distress as it hits the market? The first thing I would do to take advantage of the distress that may be coming is to not wait for a collapse that may never come, actually. You want to get into a mindset to act now. And getting your credit and your pre-approvals together with a lender is not enough. You have to understand and learn how to look for properties off market, not using the MLS. Because remember, you're going to be competing with a bunch of folks as prices drop. I mean, heck, look at the comments on my channel. Hundreds of people have responded and said, I'm waiting on lower prices. When lower prices come, I'm going to get the deal of my dreams. I've got cash to deploy. Not only that, you've got investors like me and then huge investors with billions of dollars on the sideline ready to deploy. So you will be competing with people. And so you got to get strategic now and get a plan together as to how you're going to find properties. In fact, you could probably find an opportunity today if you do the work. And I'm going to show you how to do that right now. So one of the programs I love to use is Propstream. And this is what Propstream looks like. It's basically a database. And when you pay the monthly fee, unlike Reventure Consulting, you can get info across the US in every market, even non-disclosure states. So check this out. I'm searching now for pre-foreclosure properties in Houston, Texas. And for instance, this one right here, 1115 Calderwood Drive in Houston, Texas. This was actually on the MLS at one point, as you can see here, but it was canceled. Doesn't look like it's sold yet. And this is a perfect candidate, perhaps, to send a letter to. And I'm going to show you right now what I send them. So here's the letter that I use. It's right here. It's very simple. And so all you have to do is research these properties using Propstream or another tool that you can find online, or even driving by properties that look like they're in distress and writing down the address and then doing the research. But Propstream's a great way to do it all at once. They even have a driving app that'll allow you to drive for dollars and select the properties and track them. And then it gives you the owner mailing address. So check this out. If I click on the property, I can actually see that their mailing address, this one happens to be the same as the property address. Many times it is, but sometimes it's not. And so that'll give you the mailing address. And then you take this yellow letter and you mail them the letter and ask them, hey, are you interested in selling your property? If you are, give me a call or shoot me a text message. And if you do that enough, you will find an opportunity that's off market and you can beat the investors and other home buyers to the punch. And so make no mistake, this process works. This is how I've bought the majority of my rental properties and even my flips. I even find customers this way and clients for my real estate business. But the point is, if you sit on your hands and just wait for the collapse, it's going to pass you by. One day you'll be saying to yourself, oh, if it only drops a little bit more, I can maybe buy something. They're still too expensive. And before you know it, the prices are going to go up again. So act now. Find a great deal today. Don't wait. Now, if you got some value, some insight about the housing market today, do me a favor, like the video, subscribe to my channel, give me a comment, tell me what you're thinking about the housing market. What did you think of my video? And YouTube thinks you're going to like my next video right here.